All right, today we're jumping into something that, let's be honest, scares the heck out of every investor, a full-blown market crash. But we're not just going to talk about how to survive it, we're going to figure out how you can actually come out of it stronger.
Welcome to Finance Deep Dive. Let's get right into it.
Okay, so let's start with a big question. Picture this. The market's in a free fall. Your portfolio is just a sea of red. What do you think is the biggest single threat to your long-term wealth? You might think it's the crash itself, right? But here's the thing. All the research points to something else. It's not the market. It's the person looking back at you in the mirror. Yeah, our own gut reactions, our own emotions, they're usually the most dangerous thing in the room. So, to really get why this happens, we have to pop the hood and see what's going on in our brains when everything hits the fan. Let's meet a couple of the, let's call them inner saboteurs, that are basically hardwired into our thinking. First up, we've got something called loss aversion. And man, this one is powerful. It's a simple idea. The pain you feel from losing money is roughly twice as intense as the pleasure you get from gaining the exact same amount. And that little glitch in our brains, it's a massive driver of some really bad decisions. I mean, think about it, right? You find $100 on the street, you feel pretty good. But if you lose $100 out of your wallet, it feels awful. It's a totally different level of emotion, even though it's the same amount of money. And get this isn't just a feeling or a metaphor. It's biological. Your brain literally processes a big financial loss using the same wiring it uses for a physical threat. It's a primal fear response. It feels like you're being chased by a tiger. Okay, saboteur number 2, herd behavior. You know what this is. It's that powerful, ancient instinct to just do what everyone else is doing. It's safety in numbers, even if the numbers are all running straight for a cliff. And in the market, this is where things get really dangerous. It creates this deluge of selling. Fear spreads like a virus. Everyone sees everyone else selling, so they sell, which makes more people sell, and the whole thing just spirals downwards. So, okay, these are the psychological traps. Let's take a look at how they've actually played out in history. Because these stories are always a mix of, well, ruin and riches. And look, there's no sugarcoating it. These crashes are brutal. The numbers are scary. But when you look at the data, you see another pattern that's just as consistent. Every single time, the market has eventually recovered. Let's just zoom in on one of these, the big one from 2008. The market dropped a mind-boggling 57%. Just try to imagine that for a second. Watching more than half of your life savings just vanish. A number like that, it's the perfect trigger for those inner saboteurs we talked about. That primal fear kicks in, the herd starts running, and millions of people panic sold right at the absolute bottom. They turned a temporary paper loss into a permanent, devastating one. But here's the other number, the flip side of the story. It only took 5.5 years for the market to climb all the way back. And that's the whole ballgame right there. The people who could fight that fear, who just stayed the course, they didn't just get their money back. They were perfectly positioned for the incredible bull run that followed. Patience didn't just pay off. It paid off big time. So the big question is, how do you make sure you're one of those patient investors? The secret is all in the preparation. You have to build your financial arc before it starts to rain. And here are the 4 key tools you're gonna need. 1, you need a written plan. Think of it as your compass. 2, you gotta spread your risk through diversification. 3, put your investing on autopilot. And 4, and this is crucial, you need an emergency fund. That's your oxygen tank. Hey, just a quick pause here. If you're getting some value out of this, do me a favor and hit that subscribe button. It really does help us keep making more content like this. Thanks. Okay, so let's dig into that written plan. It's your compass for a reason. You write it down when you're calm, cool, and collected. That way, when the storm hits and your emotions are going wild, you have this anchor, this document written by your past, rational self, telling you exactly what to do. Then there's that emergency fund. I love the way Warren Buffett puts it. Cash is like oxygen. You don't even think about it when it's there, but it's the only thing you can think about when it's gone. Having that 3 to 6 months of cash on hand means you never, ever have to sell your investments at the worst possible time just to keep the lights on. See, when you boil it all down, all of these tools, all these strategies, they're really about one thing: mastering your own psychology. That's the final piece of the puzzle. That's what it takes to become a truly rational investor. So here is the simple checklist, your game plan. Before the crash, you create that plan and you build that cash reserve. That's the hard work. Then, during the crash, your job is simple. Look at your plan, not the screaming headlines. Maybe even rebalance to buy some cheap assets. And after, you just maintain that long-term perspective. It's all about preparation.
You know, the great John Bogle said it best. Your success in investing will depend in part on your character and guts, and in part on your ability to realize that this too shall pass. It really sums it all up, doesn't it? It's not just about spreadsheets, it's about courage and perspective.
So, we'll leave you with this final thought. The market, it's always going to be wild and unpredictable. You can't control it. But the real question, the one that determines everything, is will you be? Hey, if you enjoyed this explainer, make sure you're subscribed. It truly helps us out. Thanks for joining us today, and until next time, stay rational.